Hello and welcome to Boni's Life, the channel where we dissect the complexities of the financial world and turn them into actionable intelligence. I'm your host, Boni, and today we're tackling the million-dollar question, or perhaps the multi-trillion-dollar question. How in the world do you trade this crypto market? We've seen a bloodbath, a brutal, unforgiving storm that has left many traders shipwrecked and wondering if the sun will ever shine again. The charts are red, the sentiment is fearful, and the headlines are screaming crash. It's enough to make even the most seasoned investor question their sanity. But as the old trading adage goes, the time to buy is when there's blood in the streets. The real question is this that time? Or is this just the beginning of a much deeper crypto winter? In this episode, we are going on a deep intellectual dive into the current state of the crypto market. We will leave no stone unturned. We'll analyze the vital signs of the market, from the total market cap and trading volumes to the fear and greed that's driving decisions. We'll look at the massive liquidations that have wiped out billions and what the open interest tells us about the battles being fought between bulls and bears. We will identify exactly what type of market we are in right now. Is it a bear market, a correction, or a giant, elaborate trap? Then we'll zoom out to look at the global stage. What are the macroeconomic forces, the central bank decisions, the inflation reports, the geopolitical tremors that are sending shockwaves through the cryptosphere? And most importantly, we will equip you with the knowledge to navigate these treacherous waters. I will provide you with concrete technical setups, key levels to watch, and tailored strategies for short-term, midterm, and long-term traders. By the end of this episode, you won't just understand the market. You'll have a plan. So grab your notebooks, silence your notifications, and let's get to work. This isn't just another market update. This is a masterclass in trading under pressure. Let's begin. All right, let's start by taking the pulse of the market. And I have to warn you, the patient is looking a little pale. As of our recording on February 2nd, 2026, the global cryptocurrency market cap is sitting at a shaky $2.7 trillion. Now, that's still a massive number, but it represents a significant haircut from its recent highs. In the last 24 hours alone, we've seen a 0.7% dip, which might not sound like much, but in a multi-trillion-dollar market, that's billions of dollars vanishing into thin air. The 24-hour trading volume is a whopping $217 billion, which tells us one thing for sure. People are actively trading, or more accurately, actively selling. Now let's talk about the king, Bitcoin. BTC is currently trading at around $77,858. It's down 1% in the last 24 hours and a stomach-churning 11.2% over the last week. Ethereum, the queen, is faring even worse, trading at $2,307, down a staggering 20.4% in the last 7 days. Other major players like Solana and Cardano are also deep in the red. It's a sea of red out there, folks, and it's easy to feel like you're drowning. So, what type of market are we in? Let's call it what it is, a confirmed bearish market in a correction phase. This isn't just a minor dip. This is a significant downturn. The data from CoinGlass paints an even grimmer picture. The Fear and Greed Index, a key sentiment indicator, is currently at a bone-chilling 13, which translates to extreme fear. This means investors are incredibly nervous, and that level of fear often precedes capitulation. But it can also be a sign of a market bottom. The question is, which one is it? Let's dig deeper. The 24-hour liquidations are at a staggering $825 million. That means nearly $1 billion in leveraged positions have been wiped out in a single day. And here's the kicker. The vast majority of these liquidations, a whopping 71%, were long positions. This is a classic bear market scenario where overly optimistic traders get squeezed out of their positions, adding fuel to the fire. The largest single liquidation order was a massive $15.46 million on a BTC USD trade on Hyperliquid. Someone somewhere had a very, very bad day. Open interest, which represents the total number of outstanding derivative contracts, is at $111 billion. While this number is still substantial, it's down 1.2%, indicating that some traders are closing their positions and stepping away from the table. The funding rates for major cryptocurrencies like Bitcoin and Ethereum are negative. For those of you who are new to this, A negative funding rate means that short sellers are paying long holders, which is a strong indicator of bearish sentiment. The market is essentially paying you to bet against it. It's like a casino offering you free drinks to bet on red when the ball has landed on black 10 times in a row. It's a tempting offer, but you have to wonder if the casino knows something you don't. So to summarize our diagnosis, we have a market in extreme fear, with massive long liquidations, negative funding rates, and prices well below key moving averages. This is not a healthy market. This is a market that is bleeding. And we need to understand why before we can even think about how to trade it. Now that we have a clear picture of the internal state of the crypto market, let's zoom out and look at the bigger picture. Because crypto doesn't exist in a vacuum, it's a small boat on a very large and very stormy global economic sea. And right now, that sea is churning. The week of February 2nd to 6th, 2026 is what I'm calling a macro storm. We have a convergence of major economic events that are all but guaranteed to inject a massive dose of volatility into the markets. The Federal Reserve, the European Central Bank, and the Bank of England are all making moves. We have critical US jobs data on the horizon and a number of significant token unlocks that could flood the market with new supply. Let's break it down. The core of the issue right now is the market's relationship with risk. Crypto, for all its talk of being a new financial paradigm, still trades like a high-risk asset. When the economic outlook is sunny, investors are happy to pour money into riskier assets like crypto in search of higher returns. But when the clouds gather and the forecast turns stormy, that money flees to safer havens like the US dollar and government bonds. And right now, the forecast is looking decidedly gloomy. We just had the Federal Reserve's first meeting of 2026, where they held interest rates steady in the 3.5% to 3.75% range. While this was expected, the market is on edge, trying to decipher the Fed's every word for clues about their next move. The appointment of Kevin Walsh to succeed Jerome Powell as Fed chair is also adding a layer of uncertainty, with many speculating that he will take a more hawkish stance on inflation. A hawkish Fed is bad news for crypto. It means higher interest rates, a stronger dollar, and less appetite for risk. This week, we have a gauntlet of economic data releases that will give us a clearer picture of the health of the US economy. We have the ISM Manufacturing PMI, the JOLTS Job Openings Report, and the ADP Employment Report, all culminating in the main event on Friday, the Non-Farm Payrolls Report. The NFP is the most important piece of economic data in the world. It tells us how many jobs were created or lost in the US in the previous month, and it has a massive impact on the Fed's interest rate decisions. A strong NFP report could signal a robust economy, giving the Fed more room to raise rates, which would be bearish for crypto. A weak report, on the other hand, could signal a slowing economy, which might force the Fed to ease up on its tightening policy, a scenario that would be bullish for crypto. But it's not just the Fed. We also have the European Central Bank and the Bank of England holding meetings this week. Their decisions will impact the euro and the pound, which in turn will affect the US dollar and the broader risk sentiment. And as if that wasn't enough, we have a number of significant token unlocks happening this week, including a major unlock for Berachain. These unlocks will release a large number of new tokens into the market, which could create significant selling pressure, especially for the specific tokens being unlocked. And let's not forget the recent crash in precious metals. Last week, silver had its worst day since 1980, and gold also took a significant hit. This is important because gold and silver are traditional safe haven assets. When they crash alongside risk assets like crypto, it's a sign of a major deleveraging event where investors are selling everything to raise cash. This is a very dangerous environment for traders, and it's a clear signal to be cautious. So, what we have is a perfect storm of bearish catalysts. We have a hawkish Fed, a slew of critical economic data releases, major token unlocks, and a general risk-off sentiment across all markets. This is not a market for the faint of heart. This is a market that demands respect, a clear strategy, and a healthy dose of intellectual humility. In the next section, we'll look at what the charts are telling us and how we can use technical analysis to navigate this storm. All right, we've diagnosed the patient and we've surveyed the stormy seas of the global economy. Now, it's time to get our hands dirty and look at the charts. Because as much as the fundamentals and the macro environment matter, at the end of the day, price action is king. And right now, the price action is telling a very clear and very bearish story. Let's start with the big picture. Bitcoin is currently trading below all of its major moving averages. The 20-day, 50-day, 100-day, and 200-day. This is a classic sign of a bearish trend. Think of these moving averages as a series of defensive walls for the bulls. The price has not just breached one wall. It has crashed through all of them. This is not a sign of a strength. The moving averages are now acting as resistance levels, meaning that any attempt by the price to rally will be met with selling pressure from traders who are looking to get out at a better price. Now, let's look at the oscillators, which can give us a sense of the market's momentum. The Relative Strength Index, or RSI, is currently at a deeply oversold level of 23.44 on the daily chart. For those of you who are new to technical analysis, the RSI is a momentum indicator that measures the speed and change of price movements. An RSI reading below 30 is considered oversold, and a reading above 70 is considered overbought. At 23.44, the RSI is screaming that the market is oversold. This is a double-edged sword. On the one hand, it suggests that the selling pressure may be exhausted and that a bounce is imminent. On the other hand, in a strong bear market, the RSI can remain in oversold territory for an extended period of time. So, while the RSI is flashing a buy signal, we need to be cautious and look for other signs of confirmation before we jump in. The MACD, or Moving Average Convergence Divergence, is another momentum indicator that can help us identify the direction and strength of a trend. The MACD is currently at minus 2067.62, which is deeply negative and confirms the bearish trend. However, the MACD is also showing a bullish divergence. This means that while the price has been making lower lows, the MACD has been making higher lows. This is a sign that the bearish momentum is weakening and that a trend reversal could be on the horizon. Again, this is not a signal to buy blindly, but it is a piece of evidence that suggests the bears may be losing their grip. So, what we have is a classic battle between the trend and the momentum. The trend is clearly bearish, with the price below all major moving averages. But the momentum indicators are showing signs of exhaustion and potential reversal. This is a market that is coiled like a spring, and it's ready to make a big move. The question is, in which direction? To answer that question, we need to look at the key support and resistance levels. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Resistance is the opposite. It's a price level where an uptrend can be expected to pause temporarily due to a concentration of supply. Right now, Bitcoin is sitting just above a critical support level at $75,000. This is a level that has held in the past, and it's a major psychological barrier. If the bulls can hold this level, we could see a bounce back up to the $80,000 resistance level. However, if the bears break through $75,000, the next major support level is at $70,000. And if that level breaks, we could be looking at a much deeper correction, with some analysts even calling for a drop to $62,000 or even $40,000 in the coming months. On the resistance side, the first major hurdle for the bulls is the $80,000 level. This is a round number that has acted as both support and resistance in the past. If Bitcoin can reclaim this level, it would be a major victory for the bulls and could signal the start of a new uptrend. Above that, we have a cluster of resistance at the moving averages between $88,000 and $90,000. And of course, the all-time high of $126,000 is the ultimate prize for the bulls. So, what does all of this mean for you, the trader? In the next section, we'll take all of this information, the market diagnosis, the macro analysis, and the technical deep dive, and we'll forge it into a set of concrete trading strategies for short-term, mid-term, and long-term traders. Stay with me. All right, we've surveyed the battlefield, we've analyzed the enemy's movements, and we've assessed our own strengths and weaknesses. Now, it's time to draw up the battle plan. Because in a market like this, Going in without a strategy is like walking into a minefield blindfolded. You might get lucky, but the odds are not in your favor. So, let's break down how to trade this market, whether you're a scalper looking for a quick score, a swing trader playing the medium-term waves, or a long-term investor building a legacy. For the short-term trader, this is a high-stakes, high-adrenaline environment. The volatility is your friend, but it can also be your worst enemy. Your goal is not to predict the next big move, it's to profit from the small intraday swings. Here's your game plan. Strategy 1 is the range-bound scalp. Right now, Bitcoin is trapped in a range between roughly $75,000 and $80,000. Your job is to play the edges of this range. When the price approaches the $75,000 support level and you see signs of a bounce on the lower time frames, like a bullish divergence on the 15-minute RSI, you can enter a long position with a tight stop loss just below the support level. Your target would be the middle of the range, around $77,500, or the top of the range at $80,000. Conversely, when the price approaches the $80,000 resistance level and you see signs of a rejection like a bearish engulfing candle on the 1-hour chart, you can enter a short position with a tight stop loss just above the resistance. Your target would be the middle or the bottom of the range. Strategy 2 is the breakout or breakdown play. This is a more aggressive strategy, but it can be highly profitable if you catch the move. You're looking for a decisive break of the current range. If Bitcoin breaks above $80,000 with strong volume, you can enter a long position, targeting the next resistance level at $84,000. If it breaks below $75,000, you can enter a short position, targeting the next support level at $70,000. The key here is to wait for confirmation. Don't just jump in on the first sign of a break. Wait for a candle to close above or below the level and look for a retest of the level as new support or resistance. A word of caution for the short-term trader: risk management is everything. Use tight stop losses, take profits regularly, and don't get greedy. This is not the market to be a hero, it's the market to be a disciplined professional soldier. For the midterm trader, the swing trader, the goal is to catch the larger waves of the market, the multi-day or multi-week moves. You're not concerned with the intraday noise, you're looking for the bigger trends. Here's your approach. Strategy 1 is the bearish continuation. Given the current market structure, the path of least resistance is down. Your primary strategy should be to look for opportunities to short the market on any signs of weakness. A good entry point would be a rejection from one of the major resistance levels, like the 20-day EMA or the $80,000 level. You could also look for a breakdown of a key support level, like $75,000. Your stop loss would be placed above the resistance level you're shorting, and your target would be the next major support level, like $70,000 or even $62,000. Strategy 2 is the counter-trend bounce. This is a more contrarian strategy, but it can be very profitable if you time it right. You're looking for a significant bounce off a major support level. The RSI is already deeply oversold, which suggests that a bounce is overdue. A good entry point would be a strong bullish reversal pattern at a key support level, like a double bottom at $74,725. Your stop loss would be placed below the low of the reversal pattern, and your target would be the next major resistance level, like $80,000 or the 20-day EMA. Patience is your virtue for the swing trader. You're not going to get a perfect entry every day. You need to wait for the market to come to you, wait for the high probability setups, and don't be afraid to sit on the sidelines if the market is choppy and uncertain. For the long-term trader, the investor, the hodler, this is not a time to panic. This is a time to be greedy when others are fearful. You're not trading the short-term swings. You're accumulating an asset that you believe will be worth significantly more in the future. Here's your mindset. Your strategy is dollar-cost averaging accumulation. This is the simplest and most effective strategy for the long-term investor. You're not trying to time the bottom. You're simply buying a fixed dollar amount of Bitcoin at regular intervals, regardless of the price. This allows you to average out your purchase price over time and reduces the risk of buying at the top. The current price levels, with Bitcoin down significantly from its all-time high, represent a fantastic opportunity to accumulate at a discount. The key levels to watch for accumulation are the major support levels we've identified: $75,000, $70,000, and even the $62,000 level. These are the levels where you should be deploying your capital. Remember the long-term thesis. Remember why you invested in Bitcoin in the first place. Is it a hedge against inflation? A store of value in a world of fiat currency debasement? A bet on the future of decentralized finance? Whatever your thesis is, you need to have conviction in it. Bear markets are the ultimate test of that conviction. If you still believe in the long-term potential of Bitcoin, then this is not a time to sell, it's a time to buy. A final thought for the long-term investor. The most important thing is to have a long-term perspective. Don't get caught up in the day-to-day price movements. Zoom out, look at the bigger picture, and remember that every bear market in Bitcoin's history has been followed by a new all-time high. This time is no different. So there you have it, a comprehensive battle plan for navigating this treacherous crypto market. Whether you're a short-term trader, a mid-term trader, or a long-term investor, there are opportunities to be found as long as you have a clear strategy, a disciplined approach, and a healthy dose of intellectual humility. This is not a market for amateurs, this is a market for professionals, and after watching this episode, you are now better equipped to be one of them. Thank you for joining me on this deep dive into the crypto market. If you found this video helpful, please hit that like button, subscribe to the channel, and share it with your fellow traders. And as always, do your own research and never invest more than you can afford to lose. This is Boni from Boni's Life, signing off. Stay safe, stay smart, and I'll see you in the next one.